Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking some time to dive into a few of the big tech giants that happen to be hitting new highs or recently hit new highs. And today we're looking at three of those stocks, and that is Adobe, Apple, and Amazon. But before we get into everything, I want to say, remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com. Also, make sure to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. All right, so we're going to do a little bit of a market recap, as I like to do to start these shows, before we dive into the main topic of today, just to give people a better sense of what's going on and how it's affecting these three stocks we're going to talk about. So stocks, as most of you probably know, surged on Friday on the back of what was way better than expected May jobs data. This helped justify Wall Street's continued ability to look beyond the current coronavirus downturn towards the recovery. So the Labor Department said that the U.S. added 2.5 million jobs in May, which blew away expectations, with economists surveyed by the Wall Street Journal expecting for a loss of 8.3 million jobs. So overall, the unemployment rate also unexpectedly fell to 13%, compared with an estimate of around 20%. So obviously, way better than expected data was a big reason why stocks continued to jump on Friday. The Dow posted its best week since April 9th last week, and the S&P 500 recently posted its best 50-day gain from its March lows to last Wednesday, and then it's climbed since then. So the S&P 500 is now up over 40% since its March 23 lows, and it's now almost in the green on the year. So as you mentioned, the recent positivity comes as economies start to reopen around the world and in the US. And then along with this reopening, it seems like Wall Street and investors are likely to remain in that don't fight the Fed mode, as the Fed and the US government do as much as they can to bolster the economy and the markets as we go forward. So amid all this comeback, it makes sense that some of the big tech stocks have been driving it as they drove that historic bull run that the coronavirus ended. And there's clearly some more immunity with these big tech stocks, and the three of them we're going to get into specifically today, as the market comes back towards maybe near its new or recent highs from before the sell-off. We do have some three big tech stocks we're going to talk about today that did hit new highs recently. And we're going to start with one of those, and that is Adobe. Adobe stock jumped right around 2% on Friday to hit all-time highs. And this is less than a week ahead of its Q2 fiscal 2020 earnings release, which is due out this Thursday, June 11th. So we're going to dive into a little bit of Adobe's overview and then see what's going on overall with the stock to see if investors might want to think about buying the stock. So Adobe sells a variety of cloud-based offerings, including its suite of creative and design-focused software such as Photoshop, Illustrator, Lightroom, and many others. So in general, its various creative software options are often considered pretty much irreplaceable by their users, and they're currently sold on a monthly subscription basis for individuals, businesses, and schools. Adobe also offers a bundle packages of these offerings, and its Creative Cloud offering can be viewed in a similar light as Amazon's Office Suite or Microsoft Office Suite, just for different services. We should also note that the San Jose, California-based firm breaks its revenue down into three streams in general, which is Creative Cloud, Document Cloud, and Experience Cloud. So along with that, Adobe has bolstered its business-focused platforms and solutions. This includes for marketing and commerce and more. We also can't forget that its PDF and e-signature business is also very important to not only its business, but its business customers as well. So if we look back to last year, fiscal 2019, Adobe's revenue climbed 24% to just over $11 billion. And this marked its fourth straight year of between 22 and 25% top line growth. So that's pretty impressive for a company that's been around for a long time. And more recently, the company topped our Q1 2020 earnings estimates in March, and it posted record quarterly revenue of just over $3 billion, with those sales up about 19% last quarter. So as we mentioned At the top for Adobe, it hit new highs on Friday of just over $396 per share. The stock is up nearly 40% since mid-March, and it's climbed about 20% in 2020 to crush the tech sector's 6% expansion. And then if we look over a longer period of time, just to give people a sense of how nice of a run Adobe has been on, they're up about 400% over the last 5 years. This outpaces Netflix and Apple over the last 3 years, as well as that run continues. And despite resting right at new highs, Adobe is trading at a slight discount compared to its year-long highs in terms of forward 12-month sales estimates. So they're trading at about 13.3 times forward sales, which is just below its highs for the last year. It is also worth noting that Adobe has consistently traded at a premium compared to its industry over the last 3 years, which makes sense if you're looking in terms of valuation. So on top of that, Adobe's cloud-based offerings are, as we mentioned, relatively unique in a crowded cloud software market that spans from Salesforce and Workday to all these other various cloud-based software offerings, whereas some of Adobe's offerings, as we mentioned, are pretty irreplaceable for its creative side. And then we should note that at the moment, it's currently a Zacks rank number 3 hold that sports A grades for both growth and momentum in our style score system. And then if we look ahead, our Zacks estimates are calling for its second quarter revenue to climb about 16% to reach $3.17 billion, and its full year fiscal 2020 sales are expected to surge over 16%, with the next year expected to climb another 15% higher to about $15 billion. So this would mark a little bit of a slowdown compared to those last 4 years of growth, but go right back in line to where they were growing at before that. So continuation of really solid top line growth for this cloud software company. And then the bottom end, its adjusted Q2 earnings are projected to climb about 28% to $2.35 per share. And its adjusted earnings per share figures are expected to climb about 25% this year, and then another 14% next year. So some solid bottom line expansion as well. The company also has a solid earnings beat history, and it's clearly poised to expand despite some rough economic conditions at the moment and going forward. So obviously some investors, as always, might be hesitant to buy stock at new highs in order to wait for a pullback, of which there certainly could be one post earnings later this week, given Adobe's impressive climb this year and since the market's lows. But longer term investors might want to consider thinking about Adobe for its ability to expand in a somewhat niche cloud software space going forward. And obviously, if you always were avoiding stocks at their all-time highs and you're trying to wait for a pullback, you might never get that chance, because if you're a longer term investor, you don't need to find necessarily the bottom at any time. You just need to keep riding it to the top. So now we're going to move on to another stock that hit new highs recently, and that is Apple. And before we dive into what's going on with Apple, it is worth jumping back a little bit. And some of this might be redundant for people who have been following Apple closely over the last several months amid all of this coronavirus stuff, but it's worth remembering just for broader context. So if we look back on February 17th, Apple warned Wall Street that it was likely to miss its revenue guidance at the time due to production in demand setbacks in China. Since then, the company has worked its way back to something close to normal operations in the world's second largest economy. Meanwhile, many of its stores remain closed throughout the US and other markets, but they are slowly starting to reopen. And then if we look back to its Q2 earnings, the company did top our estimates in both earnings and revenue at the end of April, and its non-iPhone business continued to help drive sales forward and make up for what was a rough quarter for iPhone sales. So the firm's services unit, which includes its App Store, its new streaming TV offering, and more, it saw its revenue climb 17% to a new record. And then its wearable unit, which is driven by some sales of those AirPod headphones, those wireless headphones that are really popular these days, that division surged 23% to a new quarterly record, which helped offset a 7% downturn in iPhone sales, which still accounted for about 50% of overall revenue for the quarter. And then this is why really Apple can have some bad quarters and people don't really care as a longer term investment in just a really, really stable company. So amid all of this, its adjusted earnings climbed 3.7%, which easily to $2.55 a share to easily top our estimate. The company's operating cash flow jumped by $2.2 billion to $13.3 billion, and it ended the quarter with a total net cash of $83 billion. So it had $193 billion in cash in marketable securities, alongside total net debt of $110 billion. So just cash in hand, $83 billion at the end of the quarter. And on top of that, Apple raised its quarterly cash dividend by 6%, with its next dividend payable. Well, we already missed that date at this point. So amid a time when a lot of people are pulling back on maybe dividends, the company raised its dividend. Its yield currently rests at about 1%, which tops the U.S. Treasury notes 0.87%, and compares pretty favorably to Microsoft's 1.10%. On top of that, Apple's board authorized a $50 billion increase to its current buyback program, which is great news for investors. It also shows that Apple's pretty confident in its balance sheet, and it proves that management is confident despite its near-term setbacks in terms of iPhone production and what's going on in China and the broader economy, that they're willing to buy back stock. And it does stand in big contrast compared to names like AT&T and others who have suspended their repurchase programs amid all of this broader uncertainty. So if we look ahead, our estimates all are calling for Apple's quarterly sales to slip 5% this quarter and next quarter, for its full year sales to climb about 1%, but then we're calling for a big bounce back next year with about 14.4% sales growth that following year after just 1% growth this year. And then we're calling for a bit of a pullback on both the bottom line this quarter and next quarter, but still full year earnings growth of about 3.5%, and then another 24% growth is expected that next year. And obviously these estimates are fluid and they will change as more analysts put in their updates next time Apple reports. And then we should also note that investors in Wall Street are looking to what's happening with their production delays or ramp up of their new flagship iPhones, which the Wall Street Journal and other outlets have reported that they were pushed back by about a month or so to be later this fall than normal. And Apple supplier Broadcom, their recent earnings call seemed to help support this report from the Wall Street Journal and other outlets that Apple is pushing back its production ramp up of its new iPhones. And we should also note that Apple didn't provide revenue projections last quarter for its current quarter for the first time since it started to really offer up true sales guidance back in 2003. But for all the reasons we already mentioned, along with the fact that it's seen some positive earnings revisions recently to help it earn a Zacks rank number 2 buy, that Apple might be worth considering at the moment, as it really is always. I'm not telling anyone anything super new here, that Apple is a great stock, and it's been a great stock for a long time. So far, the stock is up about 47% from the market's lows, and over 12% overall in 2020. And it hit a new high of $331.50 per share last Friday, and its market cap is now approaching $1.5 trillion. So certainly Apple is always a stock to have on your radar, and longer term investors are unlikely to look back in 12 months or more than that from now and think that the current price doesn't look like a steal at what their current price would be in a year from now. And now we're going to close with Amazon. Amazon touched new highs in May, and it's now right back near those highs on Monday, trading at roughly $2,500 a share. The stock is up about 36% in 2020 and 32% from the market's low. So it didn't fall as far. As you can see, some of the other stocks because it's kind of tailor made for the current coronavirus economy. And its pitch to investors for years has been that its business is built for the future, and this pandemic we're slowly, knock on wood, starting to recover from has kind of made that more clear that Amazon is running a futuristic sort of business in terms of cloud computing and e-commerce, with that focus on delivery, in pretty quick delivery, and it's getting quicker as Walmart and Target and other big brick and mortar retailers push into their own delivery and e-commerce space as well. So if we look back to just last quarter real quickly, Amazon's core commerce business, which includes online store sales and third-party seller services, accounted for about 72% of its revenue. So this is actually in the fourth quarter of 2019. And then its prime heavy subscription revenue accounted for about 6%, and cloud computing made up 12%. So a huge chunk of its business, as I mentioned, is that core futuristic of e-commerce and cloud computing, which are big market movers these days as well. And then its fastest growing segment at the moment is its digital advertising heavy other unit, which was up 41% in that fourth quarter, and that competes now as in third place, really behind Google and Facebook in terms of the biggest digital advertisers in the US. And then the company also competes alongside Netflix and Disney and Apple and others in that streaming TV market. So that's their broad business. And then amid all of this, as retailers were having to lay people off, Amazon was hiring more people, which obviously hurt some of their earnings in that last quarter, but their sales were still up 26% to about $76 billion in the first quarter, which was by far its highest on record for what is usually its slowest period of the year. So after that holiday period, the first quarter is normally its slowest. So if we look ahead, we're calling for the company's quarterly sales, so its current quarter sales, to jump about 27% for its full year 2020. We're calling for about 24% growth. And then on the bottom line, we are calling for a pullback. So its adjusted earnings are expected to decline about 70%, but still to $1.65 per share. And then a 14% pullback we're calling for on the full year bottom line. But then it's supposed to roar back to about 95% growth in 2020 as we hopefully move beyond this coronavirus bottom line hit. Overall, Amazon is currently a Zacks rank number 3 hold, with some mixed longer-term earnings revision picture. And then we should also note that the stock, as we mentioned, rests near its highs, but its valuation picture remains pretty solid. It's trading at 3.3 times forward 12-month sales, which marks a discount against the S&P 500's average, which is pretty impressive for a stock that has been on such a tear over the last decade, over the last 5 years. So longer-term investors, as we mentioned with Apple and Adobe, might look back in a year from now and think that this $2,500 per share for Amazon looks like a very reasonable price, to say the least, if not a steal. And before we close out, I want to just end with a look at these three stocks compared to the broader market, and then another tech sector standout over the last several years, and then more recently as well. So if we look back in so far, if this is 2020, Amazon has been the best performer of the three stocks we looked at today, up about 36%. Adobe comes in next at about 19%. Then we have Microsoft, followed by Apple, and then they're all way above the S&P 500s, which roughly sideways moving at this point, down about 0.09% on the year, with that big coronavirus downturn already almost erased over the last several months with this big comeback. And then if we look over the last year total, so the last 12 months, Apple has been the best performer of these stocks, up about 72%. And then we have Adobe at about 40% and Amazon at about 30%, 35%, with the S&P 500 up about 10% over the stretch. So Apple, the big winner over that 1 year stretch. And then if we look over the last 3 years, and this might be shocking to some investors, Adobe has been the best performer of these three stocks over the last 3 years, up about 185%. Microsoft is in there at 165%, and then Amazon comes in at third at around 157%, and then Apple is up about 120% over this stretch. So Adobe really on a nice run over the last 3 years, and then over the last 5 years as well, compared to some of these other big tech titans and obviously the market as well. And Adobe is reporting later in this week, so any interested investors might want to do some more digging before they report, and then keep an eye on what they report and what they guide to see what maybe to expect from them in the near term and the longer term. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.